Subscribe to UK Pensioner Hub for the latest updates on pensions, savings, and tax matters affecting people across the United Kingdom. Have you been diligently saving your money, watching your nest egg grow, feeling secure about your financial future? Well, I have some news that might come as quite a shock. Thousands of savers across the UK are about to receive alarming letters from HMRC, and you could be one of them. These aren't just routine notices. They're warnings that you may owe substantial amounts in tax on your savings, money you thought was safely tucked away. Before you panic, stay with me, because what I'm about to share could save you from a financial nightmare you never saw coming. The savings landscape in the UK has undergone a dramatic transformation over the past couple of years. After more than a decade of rock-bottom interest rates that barely kept pace with inflation, we've seen a remarkable shift. Interest rates have climbed to levels we haven't witnessed since before the 2008 financial crisis. For savers, this initially seemed like fantastic news. Finally, your money in the bank was earning decent returns again. Banks and building societies were competing for deposits, offering rates of 4, 5, even 6% on savings accounts. People who had become accustomed to earning pennies on their pounds were suddenly seeing their savings generate meaningful returns. But here's where the problem begins. Many savers didn't realize that higher interest rates mean higher tax bills. The tax rules haven't changed, but the amount of interest you're earning certainly has. This perfect storm has caught countless people off guard, and HMRC is now actively pursuing those who owe tax on their savings interest. Let me explain how this works. Every UK taxpayer has what's called a Personal Savings Allowance. This is the amount of savings interest you can earn each year before you have to pay any tax on it. If you're a basic rate taxpayer, your personal savings allowance is £1,000 per year. If you're a higher rate taxpayer, it's £500. And if you're an additional rate taxpayer, earning over £125,140 annually, I'm afraid you don't get any allowance at all. Every penny of interest you earn is taxable. Now, under the old interest rate environment, exceeding these allowances was relatively rare. You would have needed substantial savings to generate enough interest to breach the threshold. But today's landscape is completely different. Let's run through some realistic scenarios that show just how easy it is to trigger a tax bill. Imagine you're a basic rate taxpayer with £30,000 in a savings account earning 4% interest. That's £1,200 in interest per year. You've just exceeded your personal savings allowance by £200, which means you'll pay tax on that excess at your marginal rate of 20%. That's a £40 tax bill. Not devastating, but money you might not have budgeted for. Now let's consider someone who's been more successful at saving. Perhaps you've accumulated £75,000, maybe from an inheritance, a house sale, or years of careful saving. At 5% interest, you're earning £3,750 annually. If you're a basic rate taxpayer, you've exceeded your allowance by £2,750. Your tax bill? £550. That's a substantial sum that could come as quite a shock. For higher rate taxpayers, the situation is even more dramatic. With only a £500 allowance, you don't need anywhere near as much in savings to trigger a tax bill. £50,000 earning 5% generates £2,500 in interest. After your £500 allowance, you're paying 40% tax on the remaining £2,000, which equals £800 in tax. The numbers become truly eye-watering for additional rate taxpayers. Someone with £100,000 in savings earning 5% interest would generate £5,000 annually. With no personal savings allowance at all, they'd owe 45% tax on the entire amount. That's £2,250 going straight to HMRC every single year. Here's what makes this situation particularly problematic. Many banks and building societies automatically report your interest earnings to HMRC through a system called automatic data sharing. You might think you're flying under the radar, but HMRC already knows exactly how much interest you've earned. They're comparing this information against your tax records, and when they spot a discrepancy, you'll receive one of those letters I mentioned earlier. These letters typically arrive months after the end of the tax year in which you earned the interest. By this point, you might have already spent that interest, integrated it into your budget, or simply forgotten about it. The shock of receiving a demand for hundreds or even thousands of pounds in back taxes, potentially with interest and penalties added on, can be devastating. The situation becomes even more complex for couples. Your personal savings allowance is individual, not joint. If one partner is a basic rate taxpayer and the other is a higher rate taxpayer, you could be missing out on valuable tax-free savings if your money isn't distributed optimally between your accounts. Many couples keep all their savings in joint accounts or in one person's name without considering the tax implications. Some savers have already received these HMRC letters and are sharing their stories online and in the media. One retired teacher from Manchester reported receiving a bill for £1,300 in tax on savings interest she didn't realize was taxable. A small business owner from Cardiff owed over £2,000 after a particularly profitable year pushed him into the higher rate tax bracket. These aren't isolated incidents. HMRC has ramped up enforcement significantly. So what should you do if you've already exceeded your personal savings allowance? First, don't ignore it. HMRC has up to 20 years to pursue unpaid tax in cases of careless behavior, and burying your head in the sand only makes matters worse. If you realize you owe tax on your savings interest, you should contact HMRC directly or speak with an accountant who can help you get your affairs in order. For those who complete a self-assessment tax return, you must declare all your savings interest in the appropriate section. The form asks specifically about interest from banks, building societies, and other deposit accounts. Be thorough and accurate. If you're not sure how much interest you've earned, contact your bank or check your annual statements. Most banks provide a breakdown of interest earned during the tax year. But what if you're not in the self-assessment system? Many people assume that if they're employed and have their tax deducted through pay, they don't need to worry about anything else. This isn't true. If you've earned taxable savings interest above your personal savings allowance, you need to inform HMRC. You can do this through their online portal, by phone, or by writing to them. They'll typically adjust your tax code to collect the owed tax through PAYE over several months, though this depends on the amount owed. Now let's talk about prevention and planning. There are several perfectly legal strategies you can employ to minimize or eliminate tax on your savings. The most obvious solution is individual savings accounts, known as ISAs. Every UK resident aged 16 or over has an ISA allowance of £20,000 per tax year. Any interest, dividends, or capital gains earned within an ISA wrapper are completely tax-free. If you have savings sitting in taxable accounts and you haven't used your ISA allowance, transferring money into an ISA should be your first priority. Cash ISAs are available from most banks and building societies, and rates are competitive. You're essentially getting the same return you'd get from a regular savings account, but without any tax liability whatsoever. For couples, consider how your savings are distributed. If one partner is a non-taxpayer or basic rate taxpayer and the other is a higher rate taxpayer, moving savings into the name of the lower earner can dramatically reduce your combined tax bill. A basic rate taxpayer can earn £1,000 in interest tax-free, while a higher rate taxpayer can only earn £500. By utilizing both allowances efficiently, a couple could earn up to £1,500 in interest tax-free each year. Another often overlooked option is the starting rate for savings. This is separate from the personal savings allowance and is available to people with low overall income. If your total taxable income is less than £17,570, you may be entitled to an additional tax-free savings allowance of up to £5,000. This is particularly relevant for pensioners who have modest pension income or people who work part-time. Premium bonds offer another alternative. While technically the prizes aren't interest, they provide a return on your savings, and all prizes are tax-free. The odds aren't fantastic, and you might not win anything at all. But for higher and additional rate taxpayers who've exhausted their ISA allowances, premium bonds can be more tax efficient than keeping money in a standard savings account. Some savers are also exploring NS and I products like income bonds or direct saver accounts. While the interest from these accounts is still taxable and counts toward your personal savings allowance, NS&I doesn't automatically deduct tax at source, and many people appreciate the security of knowing their money is backed by the Treasury. Looking ahead to the remainder of 2025 and beyond, there are several factors to keep in mind. Interest rates may continue to fluctuate based on inflation, economic growth, and Bank of England policy decisions. Even if rates begin to fall, they're unlikely to return to the ultra-low levels we saw in the 2010s. This means the issue of taxable savings interest isn't going away anytime soon. HMRC has also made clear that enforcing tax compliance on savings interest is a priority. They have the technology, the data, and the mandate to pursue unpaid tax aggressively. The days of savings interest slipping through the cracks are over. Automation means HMRC can identify potential noncompliance much more efficiently than ever before. There's also been speculation about whether the government might adjust the personal savings allowance thresholds in future budgets. These allowances haven't been increased since they were introduced in 2016, which means inflation has eroded their real value significantly. However, with public finances under pressure, any increases seem unlikely in the near term. If anything, there's a risk that future governments might reduce these allowances or change how they work. For pensioners specifically, this issue deserves special attention. Many retired people have accumulated substantial savings over their working lives. These savings often represent decades of careful financial planning intended to provide security and supplement pension income. The irony is that the recent improvement in interest rates, which should be good news for pensioners on fixed incomes, has created an unexpected tax trap. If you're receiving the state pension plus a modest private pension, you could easily find yourself in the basic rate tax band. That 75,000 pounds you've saved for emergencies and treats could be generating a tax bill you hadn't anticipated. It's also worth noting that the interaction between pension income and savings interest can sometimes push people into higher tax brackets unexpectedly. If you're near the threshold between basic and higher rate tax, a good year for savings interest could tip you over, suddenly having your personal savings allowance and significantly increasing your tax bill. The message here isn't that saving money is bad or that you should avoid earning interest. Saving remains one of the most important things you can do for your financial security. The message is that you need to be smart about how and where you save. Tax planning isn't just for the wealthy, it's for anyone who wants to keep more of their hard-earned money. Take action today. Review your savings arrangements. Check how much interest you earned last tax year and whether it exceeded your personal savings allowance. If it did, deal with it now rather than waiting for HMRC to come knocking. Use your ISA allowance if you haven't already. Consider whether your savings are optimally distributed between you and your partner. Think about whether premium bonds or other tax-efficient options might suit your circumstances. Don't let the taxman take more than necessary from your savings. With a bit of planning and awareness, you can ensure that the interest you earn stays in your pocket where it belongs. The rules are clear, the allowances are generous enough for many people, and the tools to manage this efficiently are readily available. The only question is whether you'll take action before HMRC sends you that letter. Remember, ignorance isn't a defense when it comes to tax. HMRC expects you to understand and comply with your obligations, but armed with the knowledge I've shared today, you're no longer in the dark. You know the rules, you understand the risks, and you have the strategies to protect yourself. Subscribe to UK Pensioner Hub for more essential information on managing your money, understanding your taxes, and making the most of your retirement savings.